Our first topic in this unit is the circular flow in GDP. What is macroeconomics? Macroeconomics is the study of the economy as a whole. So instead of analyzing one consumer, we're going to analyze everyone. And instead of just looking at one business, we're going to study all businesses. Why study the whole economy? The field of macroeconomics was born during the Great Depression. Government did not know how to fix a depressed economy with 25% unemployment. So macroeconomics was created for two reasons: to measure the health of the economy and to guide policies to fix problems. First, we're going to look at the circular flow diagram. So we have the resource market up here and we have the product market. We have businesses and we have individuals. Businesses supply goods and services to individuals, and individuals in return spend money on those goods and services that become revenue to businesses. In the resource market, individuals provide the factors of production to businesses. Businesses pay for those factors, and those are referred to as costs. And those costs become income for individuals. So we have demand and supply on both the resource side of the market as well as the product side. We have the government as well. The government provides a variety of services, and we refer to the government as the public sector. The government collects taxes from both individuals and businesses, and part of those tax dollars are used to distribute welfare payments as well as subsidies. Important circular flow vocabulary: the part of the economy that's run by individuals and businesses is referred to as the private sector. The part of the economy that's controlled by the government is referred to as the public sector. Payments for the factors of production, namely rent, wages, interest, and profit, are referred to as factor payments. And when the government redistributes income through welfare and Social Security, those payments are referred to as transfer payments. The government also provides payments to businesses through subsidies. To review the circular flow model, do individuals supply or demand? They do both. Individuals demand products and supply resources. How about businesses? Businesses do both as well. They supply products and they demand resources. Who demands in the product market? Individuals as well as the government. And who supplies in the product market are businesses. Here's a practice question, and the answer is C. All countries have three macroeconomic goals. The first one is to promote economic growth, to limit unemployment, and to keep prices stable or limit inflation. In this unit, we're going to analyze how each of these are measured. The most important measure of growth is GDP. And GDP is defined as the dollar value of all final goods and services that are produced within a country in 1 year. So the dollar value is GDP measured in dollars. Final goods is GDP only counts new goods. GDP measures production within a country's borders, and GDP measures annual economic performance. Just like calculating your own income, GDP measures how well the U.S. is doing financially. So, how do you use GDP? You can compare to previous years. Is there growth? You can compare policy changes. Did a particular policy work? And you can compare to other countries. Are we better off? So think about this. Which 15 countries would you guess would have the highest GDP? Looking at this list, Probably not too many surprises here. The United States is third, according to data provided by the CIA. On this pie chart, the U.S. represents 24% of all global GDP. How can we measure GDP growth from year to year? We look at GDP in the most recent year minus the previous year divided by the previous year times 100 to get the percent change in GDP. Total GDP is different than GDP growth. GDP growth by country can be very different than total GDP. So if you are looking at a country that has had very little GDP growth and then they have access to new resources and start to grow, that growth rate could in fact be substantially higher than a country like the US that already has a high GDP. Does GDP accurately measure the standard of living? A standard of living can be measured in part by how well the economy is doing, but it's important to adjust it to reflect the nation's population. And this is referred to as GDP per capita or per person. So you take GDP and you divide it by the population. So that number would identify on average how many products each person makes. GDP per capita is the best measure of a nation's standard of living. So population is going to have an impact on GDP per capita. So if you look at this list here of the 10 most populated countries, the US comes in at third. This list shows GDP per capita. So notice that the US is not in the top 10, and that makes sense because we have a relatively high population. Why is it that some countries have higher GDPs? Economic systems. Capitalism promotes innovation and provides incentives to improve productivity. Rule of law. Countries that have solid institutions and political stability historically are going to have more economic growth. Capital stock. Countries that have access to more capital, meaning machines and tools, are more productive. And the fourth important factor is human capital. Countries that have better education and training are more productive. The fifth is natural resources. In general, countries that have access to more natural resources are more productive. So GDP all boils down to productivity. Output per unit of input. And here's a practice question. And the correct answer would be A. What is not included in GDP? Intermediate goods, so the goods inside the final goods do not count. Non-production transactions. Financial transactions, there's nothing produced. So stocks and bonds, for example, are not included. Used goods are not included. And then non-market and illegal activities. So household production or something that you do at home for your parents is unpaid work, as well as black market activity like drugs. The income approach adds up all the income earned from producing goods and services. So labor income, rental income, interest income, and profit. These are all the factor payments. Labor earns wages, land earns rent, capital earns interest, and entrepreneurship earns profit. The expenditure approach adds up consumer spending, which is the largest portion of GDP, 70%, business investment, government spending, and then net exports. So here's the equation. We're going to refer to GDP as Y, and then C is consumption, I is business investment, G is government spending, and then plus net exports. Consumer spending is made up of three components: durable goods such as washing machines and refrigerators, non-durable goods like food and clothing, and services, going to the dentist, auto repairs, tutoring. What percent of U.S. consumer goods is made up of durable goods, non-durable goods, and services? Over time, the amount of money that consumers are spending on services has grown substantially, and that is the largest part. And here's a graph of household consumer expenditures by major categories. In economics, we use the word investment differently than the way you might be used to hearing it, so be careful. Investment in economics is never when individuals buy assets like stocks and bonds. Investment is always when businesses buy capital like machines, resources, and tools. Does the purchase of a new oven produced in America count as consumer spending or investment spending? Well, that would depend. If it's purchased for a home, it would be consumer spending. But if it's purchased for a restaurant to be used to make pizzas, for example, then it would be considered investment. What about the production of a new home? New real estate counts as investment since a new home could potentially be rented out. What if a business produces something one year, but they don't sell it until the next year? Inventories are referred to as goods that are produced and held in storage in anticipation of being sold later. Inventories are counted in the year in which they are produced, not the year in which they're sold. The change in inventory is a valuable economic indicator. And what do you think a drastic change in inventories can mean for the economy? So look at this graph. If you look at 2008 was the beginning of the Great Recession. So you can see here that inventories fell dramatically. So that would make sense because we were heading into a very rough economic time. Government expenditures tracks the spending made in the public sector. So this includes payments made by the government for goods and services, the price of fighter jets, and the salaries of those pilots. It does not include money spent on transfer payments for welfare programs or for Social Security or subsidies. It also does not include interest payments on the national debt. What percent of the U.S. GDP is made up of government spending? Here's a practice question, and the answer is A. And another one, and the answer is B. And here's another one, and the answer is D. Another one, the answer is E. One more, the answer to this is A. And this is a practice FRQ. So if you want to pause the video, and then here are the answers.